Hello and welcome to the Ask About Wealth podcast. Today I want to talk to you about something that I was asked about in a recent interview with an online business publication. And they rang me up and asked me about the recent reductions in stock market values, attributed predominantly to the new president's tariff regime. The first question the journalist asked me was, how do people deal with the losses they've had in the last few weeks? And I said, well, in reality, they've lost nothing. Losses, as well as gains, by the way, in any investment markets, are only real when you sell. You may have heard me say this before, but let's liken it to your home. The value of your home is vitally important on 2 days: the day you buy it and the day you sell it. The value in the interim is really irrelevant. And this is true of your stock market portfolio. Now, the journalist told me today that, according to his research, about 15% of Irish people are invested directly in the stock markets. But I suggested to him that the figure is considerably higher than that because of pension funds. There are an awful lot of people out there with pension funds, and the vast majority of those funds are invested in the equity markets. So even though he may well be right, the statistic is 15% of you guys have direct equity investments or direct stock market investments, the truth is that far greater percentage of you have equity investments in your pension funds. And he asked me in terms of, what have you been talking to people about on your consults in the last few weeks? And there is no doubt that I have had consults in the last few weeks with people who say to me, my pension fund was worth 90,000 in January and it's only worth 75,000 today. And they're starting to worry about it. My only question to them was, when are you going to spend this money? The answer was 10 years' time, 12 years' time, 15 years' time. And based on those answers, my counsel to those people is stop worrying. It's like worrying about the value of your house gone down by 10 grand. It's only important when you're selling it. The other point to be made is that the world's stock markets are effectively a roller coaster. If you look through any period of history and time, the markets go up and down. The markets react to presidential tariffs. The markets react to wars. They react to pandemics. They react to a whole bunch of human-created events. But as Warren Buffett has often said and is regularly quoted as saying, timing of the markets is irrelevant. Time in the markets is what delivers success. And let me prove that to you with some statistics. While we've seen major reductions in world stock markets in the last while, the biggest single day, I believe I'm correct in saying this, the biggest single day drop in the world stock markets happened on the 19th of October 1987. We call that Black Monday. And the statistic I want to give you is, if you had invested €100,000 in that, this is S&P 500 figures, by the way. If you'd invested €100,000 in the S&P 500 on the 16th of October 1987, the day before the giant drop, or you invested the same money on the 20th of October 1987, the day after the giant drop, the difference in annual performance today is 0.66% a year. It's less than 1% a year. So that's what I mean by timing of the markets. Investing in that particular year on the 20th of October would have been the best day to invest. Investing on the 16th of October would have been the worst day to invest. But here we are 37 and a half years later, and the difference is 0.66% a year. Almost minuscule. The other point I want to make to you is, if you are an equity investor, you need to be ready for the roller coaster. You need to recognize that there will be times when your portfolio has made superb profits. There will be other times when your portfolio has made devastating losses. But neither of those two are real until you cash in. So it's not about what the market is doing today or tomorrow or by next Tuesday. It's about what is it going to do in the time frame between today, if you're a new investor, and the time you plan to stick your hand in that cookie jar, the time you plan to access the money. Regular listeners and viewers will know I lecture part-time in a private business college in Dublin. And I was talking to the kids recently, and I said to them, during my lifetime, I have lived through 6 major recessions so far. And I predicted to them that if they were lucky enough to get to my grand old age in the future, they will live through 6 major recessions in their lifetime. In the last 100 years, we looked it up before we started shooting this podcast, in the last 100 years, the global economy has suffered 15 major recessions. Capitalism is a boom and bust system. I can't predict when the major recessions will be, but I can predict that they will be, because they always have been. The only way for you and I to sit here and contemplate a future where there are no major recessions is we have to contemplate the end of capitalism. I heard an American commentator years ago talk about capitalism, and he said it's the worst economic system except for all the rest. It is arguably the best economic system humanity has been able to invent so far, but it is still fundamentally flawed. And it's flawed, let's face it, guys, because we're flawed. There is no perfect system invented by human beings because we are not perfect. I was mentioning this point to the journalist earlier, and I was telling him about another thing I've said to the kids, is that if you read, for example, Karl Marx's Communist Manifesto, it is beautiful on paper. It works perfectly on paper. The problem with it is that human beings have to put it into action. Human beings that are greedy, human beings that will benefit their family over other people, human beings that are flawed. The reason communism works for bees or termites or ants is they're not thinking participants. No worker bee wakes up on a Monday and says, I want to be the queen. But that happens in humanity. We are thinking participants. Years ago, I remember reading that the problem social science had at its beginning is it said it could predict human behavior the same way as it can predict animal behavior. But that's not true. And the example I've used in the classroom before is, imagine you take a bunny and you drop it into a pack of wolves in Siberia, or drop it into a pack of wolves in Yellowstone, or a pack of wolves in Mongolia. The end result for the bunny is the same. No matter where the wolves come from, they eat the bunny. However, you drop the same bunny into a group of human beings in those different jurisdictions, and more different, and some of them will eat the bunny. Some of them will give the bunny a name and build it a hutch and call it and lovingly pet it and feed it carrots. Some of it will strip the bunny of its fur and make a hat. You cannot predict what human beings will do like you can predict what the animal kingdom will do. And there is the problem with capitalism. It is invented by flawed individuals, which is us, and therefore it has its flaws. But as I said, probably the best system we've come up with so far. So, in terms of talking directly to, should you be worried about the current fall in markets? My answer to you is probably not. The only time you should be worried is if you're about to spend the money today. That's when it's important that values are falling away. And that's where I want to caution you out there against what I think most of the fund management businesses on the high street call lifestyle planning. And what lifestyle planning is they talk about your investments being relatively high risk in the early stages of your investment career, with the risk being mitigated by selling out of the market at 20% a year for the last 5 years, for example. Now that in sales terms sounds great. It sounds, oh, I see what you're doing there. You're reducing my risk as I get closer to spending the money. But the problem with that is it's automatic. The problem with that is it's done by computer. So if you're in a lifestyle fund where the computer said sell 20% last Thursday, it is copper fastened if you were in the S&P 500, the 9.95% loss we've experienced in this year so far. So do be cautious about automatic calls because there's no human involvement. If you had gone to your broker or your agent last Thursday and said, I want to sell out 20%, they might have said to you, oh, look, now's not a great time. Wait a month, wait 2 months, see what will happen. Because as sure as eggs are eggs, guys, as sure and as always assuming the capitalist market remains in place, there will be a bounce, there will be an uplift. And this brings me to something else I want to caution you about, and this is a human trait. We call it recency bias. What this means that human beings tend to think that what's been happening recently is going to continue forevermore. They think this when the market is booming, and they think this when the market is falling. And neither is true, guys. The truth is, if that you're invested in the world stock markets for 10, 20, 30 years, the market will boom and bust regularly. The example I used when talking to the journalist earlier was the recent Masters win. Congratulations, Mr. McIlroy, by the way. Great to see you wearing the green jacket. But the point I made to the journalist is Mr. McIlroy won the Masters, but he had a number of double bogeys, didn't he? The point is you can't win without, at times, having a backward step. So it wasn't the double bogeys that won him the Masters. It was the way he reacted to the double bogeys that won him the Masters. He didn't allow the double bogeys give him the yips. He didn't allow the last hole double bogey to affect the drive on the next hole. And that's what you need to do if you're a stock market investor. There will be losses. There will be lots of losses. If you look at the MSCI World Index, for example, in 2022, that index dropped by over 20%. In 2023, it rose by over 30%. The only people who lost 20% plus in 2022 were the ones who ran away. If they had simply waited till the end of 2023, their average annual return for those 2 years was in excess of 11%. What is the point I'm making? The point I'm making is that you are investing over the long period of time. And the value today or next Tuesday or next Wednesday fortnight is pretty irrelevant. The point I also want to add is a thing called euro cost averaging. And euro cost, if you're investing money on a regular basis, euro cost averaging is your friend. What it means is that you're buying at a range of prices, including buying at the lower prices that we've seen in the last couple of months. We ran some numbers about this. And what I looked at earlier was, imagine you'd put, and again I use the S&P 500 probably because it's the most famous index we can use. I looked at putting €100,000 into our dollars into the S&P 500 20 years ago. The average annual return, the average internal rate of return on that investment over that 20 years was 7.77% a year. However, if instead of putting the 100,000 in over 20 years, you had put 5,000 a year in over the same 20 years, so over the same period you're parting with the same amount of money, 100,000 up front 20 years ago or 100,000 in 5,000 a year bits for 20 years. But the return on the 5,000 a year was 9.74% a year. There's dollar cost averaging or euro cost averaging at work. The 100 grand once-off payment delivered 7.7% a year and a little few bob. The 100,000 dripped in over 20 years produced a 9.74% a year. That's a return, guys, that's 25% bigger, even though it's the same amount of money invested in the same index over the same 20-year term. What do I hope you take away from this? I hope you take away that the stock market is a roller coaster. If you're going to get on a roller coaster, expect the ups and downs. I was explaining to the journalists, I went to Emerald Park not so long ago with my kids, and they asked me to go on the roller coaster and I refused. And I go, go on, Daddy, please go on, Daddy, don't be a chicken. I'm not a chicken. I have experience of roller coasters. They make me sick. So I don't get on them. So if you're not able for the ups and downs, if you're not able for the double bogeys, if you're not able to ride through these events, which are inevitable, then don't get on the roller coaster. Don't invest in the stock markets. But as you don't invest, recognize that the other less volatile markets aren't going to produce the same annual return. For you, if you're already invested and you don't need to be spending the money next Tuesday, stop worrying. This will be but a blip on the overall returns in the next 10, 15 or 20 years. It'll be a blip on the overall returns if you look back 20 years and forward 20 years over those 40 years. The point is that timing is irrelevant. Time is important. To learn more about these strategies and these views and these philosophies, check out our new masterclass on the link below.